Yes, people, a very happy morning to all of you. So guys, we're going to start with a brand new topic today for the CA Foundation course, which is Bill of Exchange and a Promissory Note. Guys, this chapter, or per se I would say unit, is coming under a big chapter called as Accounting for Special Transactions. Accounting for Special Transactions is chapter number 6 of a CA Foundation accountancy book, under which you have multiple units. In that, the first unit deals with bills of exchange and the promissory note. Guys, in this particular chapter, we are going to understand what is the meaning of bill of exchange and what is the meaning of a promissory note. Second, we will understand how do we practically calculate the due date or the maturity date for bills of exchange and the promissory note. Then we will see what would be the accounting treatment if the bills are honored. If the bills are honored on time, there are 4 different cases. In each of 4 different cases, what would be the accounting treatment? We will have an understanding on the same. Thereafter, the very same bill, what will happen if the bill is not honored? In other words, if the bill is dishonored, in the same 4 above cases, what would be the accounting treatment for dishonorment? We will also have a look at that. For each scenario, we'll practically try to work out one question to understand the base before we set forward to the tough questions. Also, we'll understand the accounting treatment for the renewal of the bill and the accounting treatment for the retirement of bill. Guys, this point number 1 to point number 6 is something which you have already studied in detail in your 11th standard syllabus. So here in CA Foundation, you have all of that. Plus, there is one additional concept on which you learn how to do the accounting for accommodation of bill. Accommodation of a bill was a small theoretical concept back in 11th standard. So here in CA Foundation, you'll have a full-fledged questions based on accommodation of bill. And all the questions that has been asked so far in the ICI has been revolving around this concept only. So let's have a quick analysis of the past examination paper. So your new syllabus of accountancy was commenced from May 2018 attempt onwards. So May 18, there was no question from bills of exchange topic. November 18, there was no question from bills of exchange. May 19, guys, there was one question on renewal and retirement of bill that was for 5 marks. So it was question 3, B part of the question, where they asked a question on renewal and retirement of the bill, which is your 11th standard topic. In your November 19, you had one true and false question. That was asked from bills of exchange topic. Compulsory question number 1. Then again, December 2020, there was one question for straight 10 marks on the concept of accommodation of bill plus bill discounting. So these were the two concepts merged together and asked a question for straight 10 marks. Then Jan 21 attempt, no questions been asked from the current topic. July 21, there is no topic. No questions asked from the current topic. December 21, you again had a 10-mark question, combining two concepts again: accommodation of bill plus bill sent for collection. June 22 attempt, there was no question from this particular chapter. December 22, the latest examination which has went by, you had a question from this topic for 15 marks. Straight 15 marks, 2 concepts combining. One is accommodation of bill, second is bill discounting. So this is the history of the questions that were asked in the examination from bills of exchange topic. In your CA Foundation material, if you look at the questions, guys, the major emphasis is being given on accommodation of bill. You will see all the different varieties of accommodation of bill done properly. However, the questions pertaining to the 4 cases plus 4 cases, the questions pertaining to these 4 cases and these 4 cases are majorly missing in your CA Foundation material, because of which people do not practice these questions. And without these questions, you are not in position, or you cannot solve the questions what has been asked in the examination that comfortably. So that is the reason I have given to all of you the special class and the special book, wherein all these questions were covered as additional questions to make your base more stronger, so that when we do the CA Foundation here now, We will repeat all that. We'll repeat all these 8 cases as a quick revision, and then we'll majorly concentrate on accommodation of bill, thereby making the base very strong for all of you. So are you clear with the strategy that we are adopting? Online people, hello, am I clearly audible to all of you?
Yes, sir.
Fantastic. So now let's understand, guys, what is the meaning of bills of exchange and a promissory note. Before that, we need to understand this concept of bill of exchange or promissory note is coming into picture because of what type or nature of transaction in the business. So all of you know that anybody or any of you want to do business in India, outside India, in the world, you can either deal with goods or you can deal with services. If you want to do business, people, you have to be either a dealer of goods or services. Goods or services. If you are into the buying, if you are into the business of buying and selling laptop, so we are dealing with product, which means we are dealing with goods. If I'm giving coaching services to all of you, I'm giving coaching classes to all of you. So that is the kind of services. So anything and everything is either a goods business or goods industry business, or it is a service industry business. Now, all these businesses primarily deal with 2 types of transaction. There are 2 types of transaction. One is cash transaction. Second is credit transaction. One is called as a cash transaction. Another is credit transaction. Have you heard that the goods has been sold for cash? Yes. Have you also heard that goods has been sold on credit basis? Yes. Same thing for services. Services are given right in exchange of cash, or it is also given on credit basis. So both these goods and services, guys, transaction can be entered into either in form of cash transaction or in form of credit transaction. Cash transaction means what? Seller will sell the goods to the customer. Seller will sell the goods or services to the customer. In return, the customer will pay what? Money or consideration. In return, he'll pay, I'll not say money, I will say consideration. Something in return. So seller is giving goods to customer. In return, the customer is giving what? Some consideration. That consideration is coming immediately. One hand you give goods, another hand you receive the consideration. Now this consideration can be in form of cash, can be in form of check, can be in form of goods also, which means goods is exchanged for goods, which is technically called as barter system. Correct, no? If I am buying some goods, in return, if I'm giving consideration as some other goods, even that is a transaction. It's a cash transaction, which means the consideration is coming on the spot immediately. So in case the consideration is paid immediately, then that is called as a cash transaction. Cash transaction does not necessarily mean only cash. If you remember the subsidiary book, we used to call that as cash book. So in cash book, you had a column for cash account. You also had a column for bank account. So cash transaction means, what are they trying to mean? They're trying to mean that the consideration is paid on the spot. If goods and services are given on the spot against some consideration, those are called as a cash transaction. Am I clear with this point? Online people, hello?
Yes, sir.
Now,
Yes,
guys, credit transaction means what? The seller will sell the goods to customer, will sell the goods and services to customer. The customer will make the payment to seller, not immediately, but at a later date. So consideration is paid later. So this calls for a credit transaction. Credit transaction is basically you sell the goods now, or you give the services now, you collect the amount at a later stage. That is called as a credit transaction. So when a credit transaction comes into picture, what is the entry that you record? As a seller, what entry will you record? Debtor account debit to sales. Now the concept of bills of exchange or a promissory note, it arises in the event of a credit sale transaction or a credit purchase transaction, which means a bill of exchange or a promissory note cannot happen during a cash transaction, because the seller is selling the goods and in return the money is paid. So there the contract is over. I received the goods, money paid, the contract is over. Whereas in this case, the seller is selling the goods to the customer. Customer is yet to make the payment on a future date. So the contract still prevails. The contract for settlement of the transaction still prevails. And you will enter into a credit sale transaction or credit purchase transaction. It is only at this point of time the concept of a bill of exchange or a promissory note is being triggered. Now, how it has been triggered is what we are going to understand here in this concept. Let's take a scenario. Seller is also called as a vendor. He has sold the goods. The first transaction is he has sold the goods on credit to the buyer. Buyer is technically also called as customer. In simple language, it is called as customer. So when he's selling the goods, guys, can I say along with that, he will also give the invoice. So for a person who is selling the goods, the invoice is called as a sale invoice, sale bill. The person who is receiving the goods, the same invoice for him becomes a purchase bill or a purchase invoice. Now what happens is that the moment the sale is done on credit basis, guys, what is the entry that the seller will pass? The seller will pass debtor account debit to sales. Now what happened is this customer had approached the seller and both of them were knowing each other for a very long time. So this customer or buyer, he came to the seller and said, seller, I want so much of goods from you, but unfortunately I'm running short of cash today. I'll make the payment on a later date. So since seller knows the buyer for a very long time, out of that good relationship, he gave the goods on credit. And they've agreed that the credit period is 2 months. So after 2 months, the seller is going to the buyer. Seller is going to the buyer and asking for payment. Now at that point of time, again, customer is running short of money. But again, he's not agreeing to the fact because already once you've given a commitment for 2 months, as a good or as a prudent businessman, you're supposed to honor your words. But that fellow, every time the seller went and asked for payment, that fellow used to tell the seller that come tomorrow, come day after tomorrow. I'm busy with that work. I'm busy with that work. He was trying to postpone the payment. So imagine a person who sold the goods on credit, that to a huge amount. Normally, small amount, nobody gives credit. When do you give credit? When the amount involved is too big. So why the credit transaction is come into picture, guys? See, what happens is that when a manufacturer is selling the goods to the wholesaler, or when the wholesaler is selling the goods to the retailer, they encounter with a bulk transaction. Do you think the wholesaler, let's suppose the wholesaler is a dealer of laptop. The wholesaler is dealer of laptop. Do you think the wholesaler will go to the HP company and ask him, please give me 2 laptops? I'll sell that and come back and give you the money. Do you think the wholesaler will do that? Not possible. So when a wholesaler is approaching or a dealer is approaching the manufacturer, they buy it in bulk. They will buy 50 laptops in one shot. They'll buy 100 laptops in one shot. If one laptop is costing, let's suppose 30,000 rupees. For 100 laptop, what is the cost? 30 lakh rupees. Am I right? 30 lakh rupees, one shot payment. Is it easy or difficult for a businessman? It is definitely a difficult task. So obviously, guys, there will be no wholesaler who would be wanting to make the entire payment in one shot. And if manufacturer starts telling that, no, you pay me full 30 lakh only, then I'll give the laptop to you, then the manufacturer can never sell. Because who on earth has got the capacity to pay 30, 40, 50 lakh rupees and buy the goods every time? So that's how the concept of credit transaction has come into picture. Whenever there is a huge bulk amount involved, it is not possible for the person to pay the amount in one shot. To ensure to give him some amount of comfortability and ensure that the business is smoothly running, the concept of credit system was infused. Like the same way, here also, this particular customer has purchased in bulk from the seller, and after 2 months, this guy is supposed to make the payment. But now this customer is giving all different excuses and delaying the payment. Now imagine what will be the mentality of the seller. Will he not get scared? So this guy is nicely sleeping, and in the night, what is the dream is getting? Gone, payment gone. Like that, if this fellow starts getting a dream, don't you think that this will hamper his business? For us, you can assume that this buyer is a genuine guy, somehow in future will give the money. But if the money is not given to him on time, how will he continue his business? Correct, no? Hello, online people, do you agree with me? So seller also needs the money to come to him on time so that he can buy the goods and keep on rotating the product. Or else what will happen is the business will get stagnated. So now what happened is this seller started getting nightmare that what if this fellow does not pay the money? He started getting goosebumps. So the very next day, he went to the buyer and said that, see, I've been coming to your shop for almost 5 to 7 times. Every time you're giving an excuse. So this is clear to me that you are having still that cash crunch. You're still having that money crunch. Forget that. Let's enter into a new transaction. You tell me how much credit period further you want. You tell me how much credit period further you want, and I'm willing to give you that credit period. But whatever credit period now we are agreeing, you have to promise me that you will pay me that on time. So you give me, I will not tell you, you tell me what date, and you give me a promise in writing that you'll make the payment on so and so date. Now this buyer customer is very intelligent. Now he's thinking that if I give a promise in writing, then it is a legal tender. And if I don't make the payment on time in future date, this guy might drag me to the court of laws. So this guy again tried to delay the promise in writing. Now the seller was even more intelligent. He's like, okay, you are not preparing the document. No, wait, I'll prepare the document. Now what this gentleman is doing is that the seller is taking a piece of document. On that, he's capturing all the information. That is, who has sold goods to whom, what is the quantity involved, what is the description, what is the value of the goods, what is the tax amount involved, and this buyer on what date is supposed to make the payment, all the due date, everything in depth is being captured in the particular document. And that document is called as a bill of exchange. And second thing, what he will do is that the bill of exchange, what is drawn, he will give it to the buyer and the customer. For what? Customer has to receive that and he has to sign and give it back to the seller. Why? Because, for example, let's suppose in our example, I am giving the services to you. So can I say I'm the seller of my services? Now, one fine morning, I get up and make a piece of paper. I take a piece of paper and write that, okay, I have to get 1 lakh rupees from Disha. I have to get 2 lakh rupees from Karunya. Just because I've written this on a piece of paper, is Disha and Karunya liable to make that payment to me? In that case, then everybody will get a one fine day in the morning, prepare a bill of exchange and go to the court and tell me, okay, this gentleman has to pay me 1 crore. This guy has to pay me 2 crore. That doesn't work that way now. So bill of exchange becomes valid when the buyer or a customer acknowledges. So he has to sign and give that document back to whom? Seller. So you'll be learning in your law contract that for a contract to be executed, first there has to be an offer. The opposite person has to accept the offer. So this guy has to offer something and this guy has to accept the offer, and whatever offer is accepted, he cannot keep that with him. He has to communicate that, yes, I have accepted your offer. So 3 things has to take place: giving offer, accepting the offer, and communicating the offer. So here in same way, guys, the seller is giving the bill of exchange to buyer. Buyer is accepting it and he cannot keep his acceptance with him. If he signs and gives the document with himself, how will the seller know that he is accepted? So he has to give the document back to whom? Seller. The acceptance is communicated. Now, this entire, if these 3 steps are taken care, your bill of exchange is perfectly executed. Now, please understand, guys, until a bill of exchange was executed, this particular customer is called as a debtor. This particular customer is called as a debtor. And this debtor is unsecured in nature. It is unsecured in nature. Why? Because tomorrow, if this guy doesn't pay the money, it is very difficult to go to the court of law and get the judgment in this guy's favor. Now, on the other hand, after the bill is executed, so this guy has given in sign, okay, I'll pay you the money. Now, if this guy defaults, the seller has got the option to the court and the recovery procedure can be even more faster. I'm not telling in the first mode. In the first case, the recovery is not possible. In the first case, where the bill of exchange is not executed, recovery is possible, but the recovery procedure will get too much delayed because there is a lack of documentation at certain places. Now, when you have executed the bill of exchange, your stand becomes more strong. Your side of, this thing becomes more strong. Now, when you go and file a suit in the case of court of law, the probability of getting the money will become very high and it will get very faster. So now when a bill of exchange is executed, guys, the unsecurity or insecureness is gone, a security is being created. So when the first transaction is entered, guys, when the goods are sold on credit, at that time, you will pass the entry debtor to sales. Immediately when a bill of exchange has been executed, now the debtor has become secured, I need to cancel this debtor. So debtor is asset. To cancel an asset, I have to put the asset in credit. So it will become to debtor. So in place of that, what will I put as debit? Bills receivable account debit. So second entry will come into picture when the bill of exchange is drawn on the customer and the acceptance is being given by the customer to the seller. When the second and third step both happen simultaneously, offer is given, offer is accepted, and acceptance is communicated. In that case, the second entry will come into picture where you cancel the original debtor, the unsecured debtor you will cancel, and in place of that you create a secured debtor. Am I clear with what I'm trying to say? Now you may ask a question, sir, why two separate entries? Why can't you combine and write one entry? Normally, guys, what happens is when the goods is sold, normally credit transaction, guys, the buyer is in a different place, seller is in a different place. Let's assume that scenario. So buyer is buying the goods today. He's in a different place. On the phone is given the order. The delivery is happened. So the goods are delivered. When the goods are delivered from the seller's warehouse or the factory, upon delivery, the sale transaction is recorded. Upon the delivery, the moment the goods is going out of my premises, I have to record the sale transaction. So this goods will go and reach to the other city after 2 days. Then a bill of exchange also will be simultaneously received by him. This bill of exchange, what will he do? He will sign it and again courier it back to the seller. So can I say this process of sending the bill, receiving the bill back will take some time. So that is one reason why this transaction and this transaction happens on a 2 different date. So in an entire CA foundation course, this is what they have assumed, and at every places you will find 2 entries for this. Now you may ask a question, sir, what if the buyer and seller are on the same city, next to next shop? So goods can be immediately handed over. Bills of exchange can be immediately handed over. If that is the case, then don't need to put data. Put directly bills receivable to sales over. But that scenario is nowhere shown in your textbook. We are in a scenario where we are assuming that the goods delivery is happening, the delivery is happening a couple of days, and that by the time you get your bills receivable, it is happening on a different date. So since the transaction of sale and the transaction of bills of exchange is happening on 2 different dates, there's 2 different events. Therefore, 2 different entries have been passed. Now, do you get the concept of bill of exchange? Online people, hello?
Yes, sir.
Now, okay. Yes. Promissory note, I meant to explain. That you leave it. Bills of exchange, you have any doubt, you ask. Okay. Now, guys, the person who is, now in this case, who is preparing the bill of exchange document? Seller is preparing, because we tried to get the promise from buyer, but he was not giving it. So we took the responsibility of preparing the document. So the person who prepares the bill of exchange is called as a drawer, because he's drawing the bill. Now, drawing the bill means not literally drawing the bill. Drawing the bill means preparing the bill. The person who is drawing the bill is called as a drawer, and the person for whom the bill is being drawn is called as a drawee. Now, these terms are very much important. You might get this as a true and false. They might tell you that in the concept of bill of exchange, the seller is the drawee. True or false? In the concept of bill of exchange, seller is the drawee. True or false? False. So these terms are very much important. This is how they'll twist you. What we do in exam, no? We prepare for tough questions and go. And where do we slip? In easy questions. So we have to be prepared for every kind of question. Be it easy question, medium question, and tough question. We'll give equal importance to all the questions. The person who's preparing the bill of exchange is called also as a maker. And the person who is accepting the bill, who's signing the bill, is called as a acceptor. The person who is going to pay the money in future is called as a payer. The person who is going to pay the money is a payer. The person who is going to receive the money is called as a payee. Now, when I say payee, some people imagine that Tamil pay. No, this is English pay. Pay means the person who is receiving the money. It's called as a payee. Now, guys, from the seller point of view, this buyer is technically called as a debtor. Now, debtor account debit to sale you recorded. No. So here debtor means who, boss? Customer, na? So customer, how are you referring him? Debtor. So he is a debtor to us. Correct, no? Now, when this buyer is recording the entry, what entry he will record? Purchase to creditor. So here creditor, whom is he trying to refer? Seller and the vendor. So from buyer's point of view, this guy is called as a creditor. Now in bills of exchange, seller is called as a debtor. True or false? See, he's thinking. Everybody thinking. False, sir. Seller is called as a creditor. Online people, hello, all of you there? Or slept?
That.
There. Okay. Now, the person who is going to hand over the document to the other party, he is called as a issuer. The person who is preparing the document and handing over the bill is called as a issuer. And the person to whom the bill is handed over, the person who is receiving the bill is called as a issuee. Double E will come, issuee. Now tell me, do you have any confusions in this language? Endorser, as of now, keep it pending. Endorser, I'll explain later. Now tell me if you have any doubts here. Are you clear with the bills of exchange concept? In bills of exchange, the game is very simple, guys. The seller will prepare a bill of exchange document which will contain all the information about the buyer, seller, the goods that has been purchased, the description of goods, rate, price, amount, who will pay to whom on which date, how much amount, whether in cash, whether in check, everything will be captured on the document. And that document has been prepared by the seller and given to the buyer. Buyer has to accept it. Acceptance is important. In bills of exchange, acceptance is important. And then he has to hand over the document back to whom? Seller again. So who is the ultimate holder of the bill? Seller is the holder of bill. This is the concept of bill of exchange. Please tell me if you have any difficulties. Online people, hello. My dear online people.
No doubts, sir.
No, sir.
Very good. Now, guys, a bill of exchange is an instrument in writing. Can I say a bill of exchange be prepared in writing? Point number one, it is an instrument in writing containing an unconditional order. Unconditional order means what? Conditional order means what? We are telling that, okay, if at all you're comfortable, you pay me, or else you don't pay me. Are we going to give him a flexibility? No. We are telling him that on this date, you have to pay. There is no option for you. We are ordering him. We means who? Seller. Seller is giving an unconditional. That is, there is no condition. The opposite buyer, customer cannot put any condition. Okay, if you give me bill like this way, only I'll make the payment. Or if you come and wearing this shirt, you should wear blue shirt and come. Only then I'll give you the payment. Like that, the buyer cannot put the condition. It's an unconditional order given by whom? Seller is giving order to the buyer. Are you able to follow? This is very important from true and false point of view, people. So it's an unconditional order. Point number two. Third is signed by the maker. Maker is who here? Maker means seller. The person who is preparing the bill has to sign, or else how will I know who prepared the bill? So two people have to sign. The person who is preparing the bill, he also has to sign, and the person who is accepting the bill, he also has to sign. So signed by the maker. Third point. Now fourth point, directing a certain person. Certain person means you have to specify which person. Certain means specify specifically which person will pay the money. Will Karunya pay the money? Will Disha pay the money? Will Yogi pay the money? You have to specify the buyer's name in the document. So directing a certain person. Point number 4. Certain person means specific person to pay a certain sum of money. Fifth point is to pay a specific sum of money. You should tell that on the maturity date or on the due date, how much money exactly we have to receive from the customer. The exact amount in both numbers and words has to be mentioned. You cannot say that on due date, this guy has to pay me money. Arey, how much money? You should mention in the document now, or this document will be incomplete. So you have to mention the specific sum of money. Fifth point. Only to. Now, to whom this money to be paid? This money has to be paid to whom? The person who is going to receive the money, the receiver's name also has to be there. So there are 3 options. Only to a specific person. This is 6A. In the document, you'll mention that, okay, this certain sum of money, I'll pay only to Mr. X. Now in all the businesses, the person who is going to receive the money cannot be same now. Now, what if on that particular day, I'm out somewhere? Anita is there. So if Pratik sir's name alone is mentioned in that, then that guy will make the payment only to me. If I'm not there, he'll go back again. So if you want the money to specifically come to me only, then mention my name. But if you want to, give this money to somebody else also, then I will give one order to the order of a certain person, which means I have to mention if Anita is also authorized to receive, then okay, this amount can be also paid to Anita. We have to order or make this payment to somebody else. Like that, I will give an order to that person. It has to be paid, or to the bearer of the instrument. If you are not sure who will receive the money. If you are not sure who will receive the money, then just last at the end, please make the payment of 50,000 rupees to the bearer of the instrument, which means what? Any person who is bearing this instrument, to that guy you hand over the money. So 3 options. First is pay 50,000 rupees to Pratik, who's the seller. If you are not sure, Pratik will be there. And if you are very sure that somebody else will be there, let's say Anita is there, then second option, to order, I will order, no, make the payment to Anita. So to order of certain person. Who's that certain person here? Anita. That is the certain person. If I'm not sure whether I will be there on that day when receiving the money, or Anita will be there, or you guys will be there, or somebody else will be there, I don't know who will be there. In that case, I would not want to mention anybody's name. Instead, I will say pay to bearer of instrument, which means what? Let's suppose you are my students. Somebody is coming and giving the fees. So I'll give that bill of exchange to you, telling that this guy will come to make the payment. You give the bill to him, he will make you the payment. So you are the bearer of instrument. So you are not owner of that money. But since you are bearing the instrument, the person who is coming and giving the fees, the other student who is coming and giving the fees will give the fees to the bearer of the instrument. Bearer of the instrument means what? The person who is having the document in hand, he will be given the money to be collected. So out of these 3, any one option you can select at the end. This is what this definition talks about. This definition is laid down in section 5 of the Negotiable Instrument Act 1881. This is something you will study in your CA intermediate law paper. Now, people, do you have any problem here? Online people, hello?
No, sir.
No, sir. No, sir.
No, sir.
Can we go to the next concept, promissory note? Guys, now, promissory note, what happens is that seller is selling the goods on credit along with invoice. So the moment this transaction is taking place, the entry will be what? Debtor, account debit to sales. The goods is sent, goods is taking a couple of days to reach. Now here what happens is that in this case, the buyer is very genuine. Even before the seller is asking for a bill of exchange, the buyer himself is telling that, sir, you sell me the goods on credit. I don't have money to pay as of now, but I will give you a promise in writing that on a future date, on this particular date, I'll make the payment. So this guy is very, very, very honest and very genuine guy. He is voluntarily telling that, sir, I'll give the promise note. You don't take effort. You are giving the goods on credit. That itself is a big thing. On top of that, if I make you write bill of exchange, that's a pavam for me. So no pavam. I will take all the rest of the hard work. You just send the goods. I will prepare a promissory note and I will mention all the details from whom I purchased, from what value I've purchased, on which date I have to make the payment, what is the mode of payment, everything I will include and give it to you. So can I say this will reduce the burden of the seller now? So here in this case, guys, buyer, the customer is preparing the document. So can I say is the drawer or the maker of the bill? Bill here means promissory note. So in promissory note, guys, the drawer and maker is different. The customer, the buyer himself is preparing the document. He is not putting that burden on the seller. So the person for whom the promissory note is prepared, now seller is called as a drawee. The person who is preparing the promissory note is called as a drawer or a maker, which in this case is buyer and customer. And the person for whom the promissory note is prepared is called as a drawee. So in case of promissory note, seller is a drawee. True or false? True. Answer. True. Now, who is going to pay the money? Customer only. He is called as a payer. And the person who is going to receive the money is called as a payee. Now here, guys, if you see acceptor, I put it in red and cut it. Here, guys, the person who is voluntarily telling that I'll make the payment, is there a need to accept? You are coming and telling, sir, I'll pay you 10,000 rupees. For what you said, you will give a writing to yourself, okay, I accept to pay 10,000 rupees. Correct. When you are voluntarily telling that I'll make the payment, then here acceptance is not required. In previous case, why acceptance was required? Because the person who was preparing the document, asking for money was a different person. The person who was paying the money was a different person. So there, the acceptance was important. If acceptance is not there, anybody will get a one fine day in the morning and ask 1 crore rupees. And the other person will be liable to pay. So law says that no. If you are wanting somebody to pay you some money, he has to accept it in writing first. So in bills of exchange, the acceptance was important. In promissory note, who is taking the responsibility of preparing the document? The customer himself. So will he give the acceptance to himself? Doesn't make sense. So here the concept of acceptance is not there in promissory note. So you might get a true and false question. Then in promissory note case, in case of promissory note, acceptance is compulsory. True and false? False. In case of promissory note, since the customer is himself preparing the document, the acceptance is not required. Like that, you have to give explanation also. Why should seller accept the promissory note? Okay, now you are telling, sir, I'll come and give you 10,000 rupees. So should I need to accept it?
But then, like the buyer might specify that he wants to like pay the bill, so you might not be satisfied.
Correct. But here, this guy, when he's preparing the document, so see, he's got a point here. He's saying that, sir, if buyer is preparing the document, what if the amount is wrong? What if the date is wrong? In that case, he will throw the promissory note again on face of the opposite guy and ask him to prepare a new document. Acceptance for what? Acceptance for the receipt or payment of money. Here in bill of exchange, why the acceptance was required by the customer? Because this guy was going to make the payment. So acceptance was for what? Payment, not for other terms and conditions. Here, if you feel that the buyer is not incorporated the terms and conditions properly as you wanted, you have the authority to return back the promissory note. So in the case of promissory note, the acceptance is not required. Am I loud and clear with what I'm saying? Now, guys, the buyer, from the seller's point of view, the buyer is called as debtor. From buyer's point of view, seller is called as a creditor. For buyer, the seller is creditor, to whom the payment has to be made. The person who is issuing the bill is called as the issuer. The person to whom the bill is issued or a promissory note is issued is called as an issuee. The person who is promising to pay the money is called as a promisor. The person to whom the money is being promised to pay is promisee. Endorser, just leave it as of now. Now tell me, do you have any difficulty in promissory note? In promissory note, the person is taking the responsibility himself. The customer is saying that I will make the payment in future. That is his undertaking and promise. Let's understand the concept of promissory note. I mean, in form of definition now. A promissory note is an instrument in writing. And that should not be on a bank or a currency note. You cannot write a promise. You take a 2,000 rupee note, behind that I promise to pay you. No. You cannot, write on any legal currency or a tender of the country. So it should not be a bank note or a currency note. You take any other piece of paper, you take any other stamp paper, you can write it, but not on the currency note. So it is an instrument in writing containing an unconditional undertaking. Point number one. That it was unconditional order because seller was ordering the buyer to make the payment. But here, who's preparing the document? The buyer himself. So he is undertaking. He is himself accepting that I'll make the payment to you. So it's an unconditional undertaking. So you might get a question that in case of promissory note, it is an unconditional order by the seller. True or false? False. It is an unconditional undertaking. First point. Second point is signed by the maker. Who is the maker here? The person who is preparing basically the customer, that the buyer. Signed by the maker to pay certain sum of money. Certain sum means what? The buyer has to specify how much amount of money is going to pay. Signed by the maker to pay certain sum of money. Now, fourth point, this money has to be paid to whom? Three options. First option, only to so and so person, or to order of so and so person. So I will order, okay, make this payment to Anita, make this payment to somebody else, specific party's name. If I'm not sure on that day who will collect the money, then I will say that don't write anybody's name. Just mention pay this money to the bearer of the instrument. So like that, three options. Out of the three options, any one option you will select it, and that wording has to be there. Pay only to Pratik, pay only to Anita, or pay to the bearer of instrument. Now, this is the definition of promissory note as per section 4 of Negotiable Instrument Act 1881. Any problem, my dear friends? Hello?
No, sir.
Online only 1% responded. Everybody is just sleeping. I'm telling
Hello,
you.
sir.
See, the question now what Subiksha is asking, sir, why did they specify that this should not be done on a piece of, what is that called? Here it is. Yeah, she's asking, why did they mention that the promise should not be given in bank note or currency note? Why? Because some idiot would have done that and government would have realized it. So they said that you give promise, but don't think that this is your Appa's note and give promise on that. This is our note, government note. So you're not supposed to touch that. Somebody would have done something in past, no? Otherwise, why would government say? When you have a bad experience, only then you put that caution. Hey, be careful of that. Don't do that. So which means with government, some bad experience would have happened in past. Because of that, this warning has been given. Now, guys, if you look at the specimen is given, specimen of promissory note has been given here, and the specimen of bill of exchange has been given here. Can I go to the next part? All in people, hello.
Yes, sir.
Yes, sir.
Now, guys, what is important is the calculation of date of maturity and due date. Now, before that, now, guys, do all of you know that check is a transferable document? That is, if I receive check from you, normally what will I do? I'll take this check to my banker, I'll deposit that check and get the money. This is one option. Second option is that if you don't want to encash the check, and let's say the same check amount, the check amount is let's say for 10,000 rupees. You are giving this check to me, and the same 10,000 rupees I have to, let's suppose, pay to somebody else. So there is an option that this check, before I encash it into my bank account, I can transfer this check. I can endorse this check to the next person. So what provision is basically behind the check? If this check is a transferable document, behind the check, you will mention that this check is now being transferred to so and so person, and you'll put your signature behind. The process of being able to transfer your payment instrument from one person to another person is called as a negotiable instrument. So negotiable instrument means what? Negotiable means transferable. You're able to transfer what? Instrument. Instrument here means what? Check, bills of exchange, promissory note. We are talking about the documents. Which documents? We're talking about check, bill of exchange, and promissory note. These are the mode of payment. Check is a mode of payment. Bill of exchange is a mode of payment. You give bill of exchange, against that you get money. You give promissory note, against that you get money. So all these three are methods for payment. So these documents of payment are transferable. If you give me check, I can transfer the very same check to somebody else. If you give me a bill, I can transfer that bill to somebody else. Now what happens is that since these were the modes of different payment, guys, in the olden days, there was a lot of forgery and fraud that was happening. To control the forgery and fraud, they had bought a law called as Negotiable Instrument Act. Act here means law. So this is a law with regard to the documents which are used to make the payment, which are transferable in nature. So for those documents, there is a law that has been brought in the year 1881. It's an old law. The provisions were created in those olden days, but from time to time basis, as per the current scenario, things have been modernized and upgraded. In law, what happens is in one particular year, you prepare the law. For example, your Companies Act. Companies Act was done in 1956. It was too outdated, too old. In 2013, they bought a new law. So the company law, what you're studying now, is drafted when 2013. So from 2013 to now 2023, almost 10 years has gone by. A lot of things will change. So amendments will keep on happening. But law, when they prepare once and leave that law for some 10, 15, 20, 30 years, 50 or even 100 years. When they feel that there is a massive change that has happened, then only the entire law is changed. For example, Companies Act 1956, very old law. A lot of points were not applicable. they had no other option but to scrap that entire law, and in place of that, they had to create a new law called as Companies Act 2013. But from 2013 till now, a lot of things have been minorly changed here and there. So time to time basis, amendment will keep on coming. So like that, though this is a old law, but a lot of provisions were still applicable on today's date. And this bill of exchange and promissory note is not a new concept, my dear friends. This earlier was called as Hundi system. Earlier, this was also called as a Hundi system. Now it is called as a bill of exchange and promissory note. Now here, what happened is that in Negotiable Instrument Act, they said that if a check is prepared today, if a check is dated today, if I prepare a check with today's date, the check is valid for 3 months only. Today is what? 23/5/2023, which means this check is valid till what date? 23 or 22, 22, 6, 7, 8, 2023, which means before 22 August 2023, if you don't encash that check, the check will become a stale check, which means that will become an invalid check, which means from 23rd August onwards, you cannot encash that check. So this 3 months validity is very clearly given in the law. But unfortunately, for the bill of exchange and the promissory note, the validity of this bill was not given. So they said that this is a document where validity we will not decide. The validity, buyer and seller, you guys decide. Why? Because, for example, you are in the business of buying and selling aircraft. So aircraft, when you go and buy, if you buy 5 aircraft, guys, you have to pay 5 crore rupees. So do you think that 5 crore rupees can be paid in 3 months itself? Those people take 1 year of time to make the payment. 5 crores, no? They'll pay in multiple installment, which will go for 1.5 years also. So now, like check, if bill of exchange and promissory note is being given a validity of 3 months, then by default, the due date is after 3 months. In certain business, the 3 months date doesn't work. So what they did is, they told that whatever is the date of bill or whatever is the date of promissory note, with that, you agree a credit period and you add a credit period to that. The credit period can be 3 months, it can be 2 months, 1 month, 6 months, 12 months, anything. Or it can be in days also, 90 days, 60 days, 30 days, whatever days, whatever months you guys decide. So with date of bill, you add the credit period. Plus, you have to add compulsory 3 grace days. Why this grace days is come, you know? Because we Indians, what habit we have? When you go on a particular date for asking for payment, sir, 1 day more, sir. Next day, tomorrow I'll make the payment. You go next day, sir, 1 more day, sir. Tomorrow I'll make the payment. So we have the habit of postponing things. So government said that, law said that you don't ask 1 day, you don't ask 2 days. I'm giving you 3 days. But after 3 days, you're supposed to make the payment compulsory. So the bill of exchange, when the bill is executed or the promissory note is executed, that is the date of preparing the bill, plus credit period, whatever the credit period. In the bill of exchange or promissory note, you'll agree that, okay, today the sale has happened. So after 3 months, we'll make the payment. After 60 days, we'll make the payment. So you agree a credit period. Date of bill or a promissory note plus credit period is equal to due date. With due date, if you add 3 grace days, that becomes the maturity date. Technically, this is what it is. But unfortunately, in your entire practical questions, whether it is 11th standard or CA foundation, at so many places, they'll ask you to calculate due date. Due date means what? You should only add the credit period and leave it. No. But every places, what they've done is they've added 3 grace days and they've calculated maturity date only. So theoretically only, maturity date and due date is different. Whereas for our practical purpose, due date and maturity date means same. Means what? With the credit period, add 3 grace days and then whatever date you get, no, that is the final due date, that is the final maturity date. For practical purpose. For theoretical purpose, if you see, very clearly they have given. The date which comes after adding 3 days to the due date is called as maturity date, which means the date which comes after adding 3 days 3 days you're adding to what? Due date, which means due date plus 3 grace days is equal to maturity date. So theoretically, this is what they've said. But you see in all the practical questions, they've asked for due date. So due date and maturity date here means same. Add always 3 grace days and calculate the maturity or the due date. Online people, am I loud and clear with what I'm saying? Hello?
Yes, sir.
Yes, sir.
So now here, guys, since the Negotiable Instrument Act does not define what is the maturity or the due date of the bill of exchange and promissory note, you are in compulsion now to calculate the maturity date or due date of the bill of exchange and promissory note. So how do you calculate this? What now we are going to see. So there could be 3 types of terms of bill. The terms of bill could be of 3 types. If the term of bill is after date, then how do you calculate your due date or maturity date? Whatever the issue date, with that add credit period plus 3 grace days, you will get your due date or maturity date. So whenever in the bill, the word after date is given, this is how you will calculate the due date or the maturity date. Now, sometime in the bill, they will not use the word after date. They will use the word after sight. Sight here means what? Signature. So please understand, seller is in Coimbatore. Seller has sold the goods in Coimbatore. Today is what? 23 of May. The goods will reach to New Delhi. Let's suppose 26th of May. Along with the goods, bill of exchange also has been sent. Now tell me guys, the buyer will be receiving the bill on which date? 26th of May, when the goods is receiving. When will he sign the bill? Probably on the same day. So here the question says that the calculation of due date should be after sight. After sight means what? After signature, which means what? When the acceptance is done on 26th May, now that becomes the acceptance date, the base date. Now with that only you'll add the credit period and 3 grace days. Whereas in previous case, what happened? Since it is after date, the day when the bill is issued, that day is taken as a base date. Base date is issue date plus credit period and 3 grace days. So what is the difference? So difference is lying in this document. Here it is issue date, here it is acceptance date. So if the buyer and seller are in 2 different locations and the day of preparing the bill is different from the day of acceptance, then these 2 terms of bill is very, very important to be noted. So if the question says you after sight, then the due date will be calculated taking base date as acceptance date. If the question says that no, the term of the bill is after date, then the base date is date of issue of bill. Online people, am I clear with what I'm saying? Hello?
Yes, sir.
Yes, sir. Yes, sir.
Now, if the term of the bill says that on demand or at sight, which means give me the money whenever I demand. Give me the money whenever I demand. So here always your base date is date of issue of bill. Always it is date of issue of bill plus credit period. Now tell me one thing, people. The seller is saying that the agreement, the term is that you have to make me the payment whenever I demand. So one fine morning, I'll call you and tell, pay me the money today. In that case, do you have the bandwidth or scope of adding 3 grace days? Today morning, you're getting a call that make the payment. Where will you add 3 grace days? So if the term of bill is on demand or at sight, then how will you calculate the due date? Issue date plus credit period. That's it. You will not add 3 grace days. So here 3 grace days I've put it, I've cut it. So this document, I'll give it as a printout to you. You note it down now, don't worry. Again, I'll give a hard copy to all of you so that you can file it along with your scanner. Now, once again, now, if the question is silent with regard to the term of bill, now in the question, they're asking you to calculate the due date. After date also is not mentioned. After sight also is not mentioned. On demand or at sight, nothing is mentioned. So out of these 3, what will you assume? Which term it is? Always after date, which means the first one. Yes, Subiksha. Exactly. So basically on demand here means date of sale, some other day. Credit period, they'll agree. They'll tell that 2 months credit period. After 2 months, whenever I feel like I'll demand the money. So here the credit period is that after the credit period 2 months I gave to you, that expired. After that, whenever I feel like, I'll ask the money next day itself, or I might ask 1 month later also. That is on demand at side. Online people, am I clear with this? Hello?
Yes, sir. Yes, sir.
So let's quickly do one illustration one. I'll give you a break after that. We'll calculate the due dates. What are the due dates of the following instrument? Sorry? Here, date of transaction, that is date of selling the goods and issuing of bill of exchange, is assumed to be the same unless given otherwise. Now, first one, guys, you are supposed to calculate the due date. Now, the instrument here is bill of exchange. A bill of exchange is dated on 12 July 2021, payable 3 months after a date. After date. So, what is the base date here? The date of issuing the bill. So, what is the date of issuing the bill? 12th of July. 12th of July is the issue date. Plus, what is the credit period? 3 months. So, plus 3 months is equal to what? So, 12th July. So, August, September, October. So, 12th October is the due date. Plus 3 grace days is equal to 12 means 13, 14, 15. 15th October is your maturity or the due date. Any difficulties? Offline people? Online people?
No, sir.
No, sir. No,
I would have bypassed this question since already all of you have done this in the special class. I would have bypassed it. But why I'm doing is few people have not still done with this. We have 2-3 new people coming in. They've not done it. So I have no other option. If I don't take it from base, no, they'll not understand it. So that's the reason I'm going a little bit slow, but I'll not go as slow as we've done in the special class. The pace will be a little bit faster. Next one. Second document. A promissory note. Now it is a promissory note. Who prepares the promissory note? Acceptance is required? Not required. Only people not responding. Nobody is responding. Now, a promissory note dated 31st March 2021, payable 90 days after date. Now, guys, whenever this month is given, no, you will have a gala time to calculate. You will have problem only when the days is given. You have to be very, very careful. So now, guys, promissory note date is 31st of March and the credit period is 90 days. So you have to calculate the due date. So 31st of March 2021. Guys, plus 90 days plus 3 grace days is equal to what will be this date? How will you calculate? $90 days of few months. Now 31st March is the bill date, guys. The next date is what? 1st April. So next is April month. So out of 90 days, how many months of April will be gone in the credit period itself? Out of 90 days, 30 days will go off. 30 days minus 30 days of April. So remaining will be 60 days of. So here it is 90 days of April, May and June. Totally, guys, credit period is 90 days. After 31st March, 90 days means what? Can I say April, May, June put together? So these are the 90 days of April, May, June. From the 90 days of April, May, June, if I minus the 30 day of April, I'll be left with 60 days of May and June. If I minus 31 days of May, I'll be left with 29 days of June, which means I will land on the 29th day of June. 29th day of June. So 29th day of June plus 3 grace days. June has got 30 days. So 29th, leave it. 31, 2. So 2nd of July 2021 is your due date. Which means from 31/3/21, if I add 90 plus 3, 93 days, you will land up to the 2nd of July. So listen to me very carefully. One more time, I'll repeat. It's very simple. 31st March, we have to add 90 days. So after 31st March, 90 days of what? How many months? April, May and June. Correct. Approximately. Even if I say 80 days of April, May and June. Somehow June is also getting included. From this 90 days of April, May, June, or 90 days of future month, if I minus 30 days of April, I'll be left with 60 days of future month, which is May and June. From that, if I minus immediately the next month, May, 31 days of May, if I minus it, I'll get 29 days of June. So 29th June is your due date, plus 3 grace days, which means 31, 2. So 2 of your July is your due date or the maturity date. Second of July. So adding 3 grace days, the promissory note becomes due on 2nd July. 2nd July 2021. Any problem? Online people, any problem?
No, sir.
Shida says no problem. Navya says no problem. Mohit, Akhil, Alvin.
No, sir. No.
Selina, Srinidhi, comfortable?
Yes, sir.
Oh, everybody is nicely switched off the videos. Huh? Mohit video is switched on. Navya is on. Others is nice. Let's see. Fully relax, everybody. Huh? Now, third one. A bill of exchange dated 5th August 2021, payable 60 days after sight. And acceptance is on 10th of August. So after sight means what? You should calculate the credit period from which date? Acceptance date. So acceptance date is 10th August. So don't calculate from 5th August. 10th August is the base date. From there you will calculate 60 days. So 10th August 2021. 10th August is the acceptance date 2021 plus 60 days plus 3 grace days. So now guys, we are in 10th of August. After 10th of August, 60 days, which means 60 days of August, September, October. Totally, approximately. I'm not telling exactly. See guys, we are in 10th of August when the acceptance is done. So after that, if I have to calculate 60 days, means it will go somewhere August, September until October it might go. So from 60 days of August, September and October, how many days I can minus? First, I need to minus the August ka date. Now listen to me very carefully. This is August month, okay? So today we are on 10th of August. From this period to this period gone. August is totally got how many days? 31 days. In 31 days, 10 days if it is gone, what am I left with? 21 days. So from 60 days of August, September and October, minus 21 days of August. Because that much only left was. Out of 31 days of August, 10th only the acceptance is happening. So from 11th onwards, only will count now. So 11 to 31 is 21 days. From 11th of August to 31, balance days in August month is how much left? 21 days. So from 60 days, you minus 21 days of August, we'll be left with how much? 39 days of September and October. So September has got how many days? So minus 30 day of September. So you land up to the 9th day of October. So 9th October is the due date plus 3 grace days, 10, 11, 12. So 12th of October. So 12th of October is your maturity date. Hello. Okay, not okay. Online people.
Okay, sir.
Okay, sir. Okay, sir.
Yes, sir.
Fourth one, I want all of you to try. Bill of exchange dated 30 June, payable 3 months after date. Now you try by yourself and tell me the maturity date. Done? What is it? Online people? Hello?
October 3, sir.
October 3, 30 June. So July, August, September. 30th September. 30th September plus 3 days of grace. So 30th September ka next day is 1st October. 2nd October, 3rd October. So 3rd October is the due date. Got it, Kana? No problem. No? Okay. 3rd October. 30 June plus 3 months is 30 September. 30 September plus 3 days is 3rd October. Very simple, pure mathematics. If you don't know mathematics, I can teach. Jain.S say, sir. Okay, okay. Now, before I go forward to the 5th point, one thing I want to discuss with all of you. Now, guys, if your maturity date is a holiday, that is after including grace days. Obviously, after including grace days only is maturity date. If that maturity date is a holiday, now holidays of 2 types. Sir, we know only one holiday where we can sit and enjoy. What 2 holiday you're talking about? Wait. Now, if it is a public holiday means what? Now tell me guys, Sunday, do you feel is a public holiday or not? Yeah, Sunday means nicely sit and sleep. Other people, not you guys. You have to come to class. No. Good is like, sir, Sunday we will sleep. Huh? Other people. Public holiday for other people. For CA students, no Sundays, public holiday. Every day is working day. But for other people, public holiday, Sunday. Okay. August 15, public holiday. Then your Republic Days, Jan 26. So all these public holidays there, no? Gandhi Jayanti, October 2, then Children's Day, certain public holidays. So if your maturity date falls on a public holiday, now will you make the payment on the public holiday? In the public holiday, boss, bank should be working. Business people should be working. Both are not working. Correct? No. For me to make the payment or exchange payment, buyer should open a shop. Seller should open a shop. When only both of them can meet each other and get the money. Or if it is a check, banker has to be open. So on a public holiday, all the business, all the banks, everybody is closed, boss. So on the maturity date, if it's a holiday, public holiday, will you make the payment? Will you get the payment? No. So in that case, your maturity date will be previous day. For example, if your maturity date is falling on a Sunday, then Saturday will be the revised maturity date. I'll be to follow. If your maturity date as per this calculation, if the maturity date as per the calculation is falling on October 2, Gandhi Jayanti, then October 1 will be your due date, maturity date. Because you very well know when you are issuing the bill, today very clearly you know that the maturity date is a public holiday. When you know the public holiday is there, then the previous day becomes the due date. And on that due date, the payment has to be honored. So public holiday means Sunday or any other day declared by the central government as holiday in the notification of the official gazette. Official gazette is the government document. In the gazette, if they mention that this particular day is holiday and that is known to you in advance, because yearly, now August 15 is holiday, we know since so many years. Because in official gazette, they mentioned that August 15, Republic Day, Independence Day, everywhere will be holiday. Everything will be holiday. So when that is known to you in advance, the due date in that case will be the preceding business day. Preceding business day means what? Preceding working day. Preceding working day. If the preceding working day is also holiday, then preceding working day. If Saturday is also public holiday by due to any reason, then Friday will be your due date. If the preceding day is also a public holiday, the due date will be the day preceding the previous day. Then previous to previous day. Okay. This is one type of holiday. Another type of holiday is basically an emergency or unforeseen holiday. Like we had COVID. COVID, did they put in the official gazette that 1 year after you'll have COVID, so there will be a lockdown? Nobody knew. It just happened. Another example is Bandh. Yes, all of you have heard this word Bandh. So one day before you'll get to know that, or 2 days before you'll get to know that on this particular day there's a Bandh. So this is something which is happening as an emergency. You never predicted it. It is unforeseen. You've never seen that a holiday will come in future. It all of a sudden came in between. In that day, what will happen? Your maturity date will be the next day. For example, let's say today is what, 23 May. Today is Tuesday. You never expected suddenly today is holiday. Because of being holiday, the shops are closed, banks are closed. So obviously the payment cannot happen. And you cannot tell that it will be previous day because you got to know only about that yesterday. It is very early for him to make the payment yesterday. So the advantage what is given is you take the next following day as the due date. Which means if it's an emergency or unforeseen holiday, the due date will be the next day. If it is known to you already, public holiday, it will be the previous day. Online people, am I clear with what I'm trying to say? Hello?
Yes, sir.
Very good. Fifth one.
Yes, sir.
A promissory note dated 27 November 2021, payable 60 days after date without grace. Without grace, they're telling. So what type of a term is this? On demand or at sight? So guys, 27th November, payable 60 days after. So 27th November plus 60 days. So now guys, 60 days of what? November, December and Jan, approximately I'm taking. From that, how many days of November is yet to be subtracted? Guys, we are on 27th of November. 28, 29, 30. 3 days of November is still pending. If I minus 3 days of November, I'll be left with 57 days of December and Jan. From this 57 days, if I minus 31 days of sorry, December, 31 days of December, I'll be left with 26 days of Jan. So now guys, 26th Jan is your due date. 26th Jan is what day? It's a Republic Day. It's a public holiday. So you know that public holiday in advance? Yes. So in that case, your due date will be the preceding day, which is 25th of Jan. Online people are able to follow?
Yes, sir.
Yes, sir.
Yes, sir.
Since 26th Jan is a public holiday, the promissory note becomes due on 25th January, which is the previous date. Okay, not okay.
So, but then do you pay it on the due date or the maturity date? On the maturity date, no?
So here in our all practical questions, the due date and the maturity date is same, which is supposed to be actually 26th Jan as per the calculation. But since 26th Jan is a public holiday, then your revised due date or the maturity date becomes 25th of Jan.
So, but you have to add 3 to it now. So, it'll become
But
29.
no, but the question is very clearly told, no? Without grace.
Acha, okay, okay.
Every single word is important, people. Without grace, they have told. So obviously, you will not add the 3 days. Now clear, Navya?
Yes, sir.
Okay, let's slip in for a quick break of 4 minutes. We'll come back and continue. Thank you. Yes, people, welcome back from the break. So let's continue. So guys, now straight away we'll be heading towards the 4 cases which I was discussing in the beginning, people. If you remember, we agreed that we will discuss what is the meaning of bill of exchange and the promissory note. So we understood what is the meaning. Second thing, we understood how do we calculate the due date or the maturity date. So now we'll be understanding that in these 4 scenarios, how an accounting treatment is done if the bill is honored on time. So these 4 cases, we'll see one practical question in each cases. So let's go forward. The first case is basically, people, the question says that a bill is retained till maturity. This means what? The seller has sold the goods to the buyer, along with invoice plus bill of exchange, and this buyer is accepting the bill and giving it back. So acceptance also is done. Now in this transaction, the seller will hold the bill with himself till the date of maturity, and on the date of maturity, the seller will present the bill to the buyer and buyer will make the payment. Very simple case. We are going to discuss a very simple case. So let's take a practical question to understand this. So on 1st April 2021, Ram sold goods to Mohan for 50,000 rupees. Who is the seller? Swati, who is the seller? Seller. Ram is the seller. Who is the buyer? Mohan is the buyer. Value of the goods is 50,000 rupees. On the same day, Mohan accepted a bill drawn upon him by Ram at 3 months for 50,000 rupees. Now, people, there's a bill that has been drawn upon him by Ram. So, who is the drawer of the bill? Ram. So, is this a question of bill or promissory note? It's a bill of exchange. And the term period is for 3 months. Amount is 50,000. What is the this thing? Term of the bill, not term period. I'm asking term of the bill. Term of the bill is nothing mentioned. Nothing mentioned. The question means always after date. After date means what? Issue date plus credit period plus 3 grace days. So what is my due date, please? Issue date is 1/4/2021 plus credit period is 3 months plus 3 grace days. So April, May, June, July. So July 1st plus 3 grace days is 4th of July 2021, which means till 4th of July 2021, Ram is holding the bill with himself, and on the due date, the bill was met, which means on the due date, Ram is handing over the bill to Mohan, and Mohan is in return making the payment. There is no problem. Everything is gone very smoothly. Give the journal entries in the books of both the parties. Both the parties means first Ram, then Mohan. Now, guys, all of you please write the heading in the books of Ram. In the books of Ram, journal entry or journal of Ram. Anything you can write. Heading is important. Plus, please write the format, date, particulars, LF, debit rupees, credit rupees. Please do the format, then we'll go with the transaction.
So all this is there. I mean, it's 11th grade, Kano.
This is 11th grade because these basic questions are not there in the CA foundation material. I'll show you the very first question of CA foundation material today evening. You'll be flabbergasted that the way the question, the first question is twisted and asked. No, if anybody does that question, no, clean bold. So I'm just trying to set up a base, a rapport for you, so that when you come for the tougher questions, you'll have it, a proper head to manage it. So all these are yes, TSG. Guys, the first transaction will be the sale transaction on the date of sale, 1st April. First, guys, a bill is being sent along with the goods. What did I tell you? When the goods are sent, when the goods are getting out of your godown or a factory, you're supposed to record a sale transaction. When the goods are sent out, do we have the bill accepted in return? No, bill is accepted in return on a different time. Everything is happening on same day. First, the goods are dispatching. Along with that, invoice and bill of exchange is going. Later, bill of exchange is being accepted and bought back. So first, always sale transaction. So here it is a credit sale. So debtor to sale. Who is debtor here? Mohan. So Mohan account debit to sale 50,000, 50,000 being goods sold to Mohan on credit for 50,000 rupees. This is the narration. Being goods sold to Mohan on credit for 50,000. Now Mohan account here, guys, is secured or unsecured? It is unsecured. Now, guys, on the very same day, you have got the bill signed by the debtor and it is come back to you. Now, when the bill is coming back to you in the signed format, now do you feel Mohan is safe, secured or unsecured? Secure. So now we have to cancel the unsecuredness. The unsecured part we have to cancel. Mohan is currently in debit. Mohan is unsecured, which is currently in debit. To cancel Mohan, I have to put Mohan in credit. So unsecured. And in place of that, a secured account has to be created. And the name of the secured account is bills receivable. This is also pertaining to Mohan only. But the security is there. So the new wrapper that we are covering on Mohan is bills receivable. So the new account name is bills receivable. So this is also asset. This is also asset. Here the asset increases. Here the asset decreases. Guys, here in foundation, 99% at every places will be applying only the modern rule. So you have to be familiar with the modern rule. If anybody is not clear with the modern rule, please let me know. So this is on date of acceptance of bill. On the date of acceptance of bill. Bills receivable to Mohan. So what happens now? Mohan debit, Mohan credit is cancelled. So what is the net entry? Bills receivable to sales. That is the net impact of the two entries. Now what happens? On the due date, the bill has been met. The question very clearly says that, sir, on the due date, the bill was met. Means the bill is honored. Another way of explaining this sentence is, on the due date, the bill was honored. Like that, they can change the language, but the emotion is same. Which means what? On the due date, money is received. So what will happen on the due date, 4th of July, which we calculated? Ram will take the bill and go to Mohan. He will give the bill to Mohan. Take this bill and give me the money. So can I say, from my hand, the bills receivable is going out, credit what goes out? Or the asset is going out. So to decrease an asset, credit. So bills of exchange is going out. Bills receivable is gone out. And what am I getting in? Debit what comes in? What is coming in? Cash is coming in. So cash account debit to bills receivable. Cash account debit to bills receivable. Being cash received against Mohan's acceptance. Now here, once the bill is touched the due date or the maturity date, ensure that the bill has been cancelled. So bills receivable debit and bills receivable credit. Can I say the account is closed and cancelled? Yes. On the due date, guys, whether the bill is met or not met, on the due date, whether the bill is honored or dishonored, the bill of exchange will always be credited and knocked off. On the due date, the validity of the bill is over. So whether the payment is made or not made, you have to close the bills receivable account. The bills receivable account is valid only as long as the bill is live. It is within the credit period. Once the credit period is passed by, the validity is lost. Now guys, very simple question, just to set a base. Any problem here? Online people, hello?
No, sir.
No, sir.
No problem.
No.
Now you have to record in the books of Mohan. In the books of Mohan. Mohan is basically the buyer of the goods. So on the date of purchase, which is what date? 1 April 2021. What did we do? We have purchased the goods. What is the purchase credit purchase entry? Purchase account debit to
Ram.
Ram. Creditor is Ram. 50,000. 50,000. Please do draw with proper formatting. Being goods purchased on credit from Ram worth 50,000. Narration, you can grammatically form any sentence you want. There's no hard and fast rule that you have to do like that and like that only. You're free to form any language you want. On the date of acceptance, on the date of accepting the bill of exchange, that is 1/4/2021. Now Ram until that period was unsecured. Now when the bill is accepted, Ram becomes secured. So it will be reversal of Ram. We need to cancel Ram's account. So Ram I'll put in debit. Ram is currently in credit. To cancel Ram, I need to put him in debit. And in place of that, new liability is created in the name of bills payable. Yes, Ram is a liability. Now we are reversing this liability here. We are reversing the unsecured liability and creating a secured liability, which is bills payable. So Ram account debit to bills payable. Bills payable is a liability. To record liability as per modern approach, we have to credit it. We have to credit it. And on the date of maturity, on the maturity date, on the date of maturity, which is 4 July 2021, guys, the bill liability is being closed. The liability is closed. So when the liability is closed, what do we do? Liability is currently in credit. To close liability, we'll put it in debit. So bills payable account debit. And what are we doing? We are giving the cash. In other words, Ram will give bill to us. Debit what comes in. So bills payable is coming in. Debit what comes in. And credit what goes out. Cash is going out. Okay, not okay. We'll take the bill and we'll make the payment. No? This is a simple transaction. This is a scenario where the bill is held by the seller till the due date, till the maturity date, and the bill is honored. Simple case. Any problem here? Hello?
No, sir.
Online only one said no problem, sir. Others are nicely sleeping. I know.
No, sir. Done.
Others.
Done, sir.
So this is a normal credit sale transaction. This is the journal entry upon the bill being accepted or a promissory note being executed. And this will be the entry when the bill is honored. This I meant to discuss. So this will be discussing in today's evening class when I do the remaining 4 cases of dishonorment. This will be the journal entry for purchase, credit purchase. This will be the bill of exchange execution entry. And this will be the entry on the payment being honored. Upon dishonorment, we'll do this today evening. Next concept, guys. When a bill of exchange is discounted with the bank. Now understand the scenario. Very nice scenario. Online people, am I clearly audible with what I'm saying?
Yes, sir.
Yes, sir.
No disturbance in the internet, no?
No, sir.
Okay. Now,
No,
guys.
sir.
Now we are going to the case 2. Case 2 is where the bill of exchange has been discounted with the bank. Seller sells the goods on credit, plus along with that he will send the invoice plus bills of exchange. Okay. Now, guys, the buyer will accept the bill of exchange and give it back, or he will execute the promissory note from his side. So this is a second step. If it is a bill, he will accept and give it back. If it is a promissory note, he will prepare and give it. So this is the second step. Now here, guys, the credit period that is agreed is 3 months, which means seller has sold the goods today, which means seller will get the money after 3 months. Now what happened is that 3 days later, the seller is in very urgent need of money. Seller is in very urgent need of money. If this seller goes to the buyer and asks after 3 days that give me the payment today, you think the buyer will make the payment? Buyer will say get lost, because you have already given me a 3 months credit period, and for that you have executed bill of exchange also. How dare you come and ask me earlier? Get lost. Come after 3 months. Now, power this fellow is sitting outside and crying. Now, there is a nice gentleman from the back. He came. My dear friend, why are you crying? And this gentleman is supposed to be the banker. So banker is asking the seller, why are you crying like a small baby? Seller is saying that, sir, I'm in urgent need of money. And my customer, we have promised each other that we'll collect or receive the money after 3 months. But urgently today I'm in need of money. I went and asked money from this fellow. This guy said, get lost. That's why I'm crying. So banker is a very kind-hearted person. Like that you will think. But he has got a strategy in his mind. He's saying, why are you worrying? Now for this transaction, do you have a bill of exchange with you? Seller smiles and says, yes, I have a proper bill with me. He's like, come to my office. So this seller is going to the banker's office. Banker is saying that, why are you crying? I will give you that money. The moment like the statement is done, the seller is jumping out of joy. But seller is expecting the full amount to come. Do you think banker is a fool to give you the full amount? No. Now, since banker is going to help you in your problem, obviously he would want to make some money out of that help. Nobody does today free of cost to anybody. Whatever somebody does, there has to be some hidden profit motive. So here when banker is helping the seller, so banker is saying that, see, you are in need of money today. You will get this money from the buyer on a future date, which means I am going to give you this money as a kind of a loan for which you have to pay me interest. Normally, the loan procedures are very tedious and very complicated. But sometimes in the bill of exchange, since bill of exchange is a valid document, without too much of complications, the banker is willing to give the loan. So this is one of the means of also getting the loan, and that concept we'll learn in the accommodation of bill. So as of now, we'll keep it very simple. The seller is going to the banker and giving the bill to the banker. In return, banker is giving what? Giving the money. Any problem? So let's suppose the transaction is for 50,000 rupees. The bill that the buyer has to pay is for 50,000 rupees. So bill worth 50,000. 50,000 worth of bill is given to the banker. And will banker give you full 50,000 rupees? The answer is no. Banker will give you 49,900. You have given him the bill worth what? 50,000. Banker is giving you how much? 49,900. So from banker's pocket, how much money is gone? 49,900. Now, you got 100 rupees less. 100 rupees is not a big deal. Fine, let it be. You are getting today 49,900. With that, the seller's problem today is solved or not solved? He was in urgent need of money, 50,000 rupees. He got 49,900. His problem is solved or not solved? It is solved. The process of giving the bill to the banker and getting this money, this process is called as discounting of bill. Discounting of bill means what? You are giving him 50,000 worth of bill. After a discount of 100 rupees, you are getting back 49,900. This concept is called as discounting of bill. Now, what will happen? On the due date, on the maturity date, who is the holder of the bill now? Bank is the holder of the bill. Who is the bearer of the instrument? Bank. So, do you remember bills of exchange? Give this money to the bearer of the instrument. Now the bearer of the instrument is bank. So who will go to the buyer and get the money? Banker. So banker will go to the buyer and get the money from the buyer. So how much will buyer make the payment? Buyer will give 50,000 rupees. So how much money the banker is getting? 50,000 rupees. Earlier he paid 4,900, so negative, and today is receiving 50,000 rupees. So totally, what is the difference? 100 rupees. Positive or negative? Positive 100, which means in this transaction, how much money did the banker pocket? 100 rupees. So this is basically the interest for the money that he has lent for the credit period of 2 or 3 months, whatever we have agreed. This entire process is called as a bill discounting with bank or discounting of bill with the banker. Any problem, online people?
No, sir.
No, sir.
So bill of exchange is acting as a document, as a valid document, a good document on basis of which you can take loan from the banker for a short period without giving any security as collateral. You are getting that money for a shorter period. So that is the advantage of one of the advantage of the bill of exchange or the promissory note. Now guys, let's quickly look into a practical question to understand this better. Prakash received from Mohan an acceptance for 30,000 on 1st July 2021 at 3,000. Prakash received from Mohan an acceptance. Who's the buyer? Who's the seller? Prakash is the seller. Mohan is the customer and buyer.
Prakash is the buyer.
Prakash received from Mohan an acceptance. Who's giving acceptance? Mohan is giving acceptance. So if in the case of bill of exchange, who gives the acceptance?
Buyer.
Seller.
Hey, Akil. In the case of bill of exchange, who gives acceptance? Buyer, no. So Prakash is my seller. Now clear? Because if this is not clear, then you will have a problem in passing the journal entries. You should be knowing who's seller and who's buyer. Because for seller is a sale transaction, for buyer is a purchase transaction. So both entries are different. So here, if I call Prakash as a seller, do you have any problem? So Prakash has sold goods to Mohan. Along with that, he has sent the bill. Mohan is accepting and giving the bill back. So Prakash received from Mohan an acceptance. So who is giving acceptance? Mohan is giving acceptance. So he's the customer, he's the buyer. And acceptance is for 30,000 rupees. And the acceptance is given on 1st July 2021. Here the question is not clear when the bill is issued, when the bill is accepted. In the absence of the information, the issue and acceptance is happening on the same date. Credit period is how much? 3 months. What is the term of bill? Term of the bill? Nothing mentioned, so it is after date. So please tell me, my dear friends, if 1st of July is the issue date, plus credit period, plus 3 grace days, what is the maturity date or due date?
October 4.
1/7/2021 plus 3 month plus 3 grace days. So July is there. So after July, 3 months means August, September, October. October 1 plus 3 days means 4th October 2021. Is this a public holiday? Is this an unforeseen holiday? Nothing mentioned. So this will be my final maturity or the due date. Now, Prakash got this acceptance discounted at 12% per annum at his bank, which means what? Prakash is not holding the bill till maturity. If Prakash has been holding this bill till date of maturity, then it becomes case 1. Is he holding the bill with him? No, he's got the bill discounted with the bank. So this is case 2. So who's the holder of bill here? Banker. So banker for this service is charging how much interest? 12% per annum. 12% is for per annum. Per annum means what? 12 months. But here we are going to take the money from banker for how many months? 3 months. Here, when the bill was discounted, it is not given. In the absence of the information on the date of discounting of bill, we'll assume that the same day has been the discounting day, which means on the very same day of issue, on the very same day of acceptance, the bill has been discounted. Sometimes the question will tell you the date of discounting. If nothing is mentioned, it will be the date of issue or acceptance. Clear now? So 1st July, they have received the money from the banker, and banker will get this money on 4/10. So technically, how many months you are enjoying this money? 3 months. So interest has to be calculated for 3 months. On the due date, Mohan paid the required amount. Mohan paid the required amount to whom? Hello, online people. On the due date, Mohan paid the required amount to whom? Who is presenting the bill? Banker will present the bill to Mohan, and Mohan will repay the money to the banker. Give the entries in books of Prakash and Mohan. Can we do it? Guys, are you clear with the scenario diagram? Anybody is having any difficulty in this diagram? The sequence, if you understand only, guys, in the same sequence, the journal entry will be passed. Now listen to me very carefully. The first sequence is what? We are recording in the books of whom first? We're recording in the books of Prakash. So Prakash is seller. So please understand, guys, the first transaction is happening between Prakash and Mohan. So what will be the first journal entry in the books of Prakash? Please write with the proper heading in the books of Prakash, journal entries. Format is very important. Date, particulars, LF, debit, credit. Now, what is the date of sale? 1st July is the date of sale. So 1/7/2021. Guys, when the goods is dispatched, you have to pass a normal credit sale entry. So what is the normal credit sale entry?
Mohan account to sales account.
Mohan account debit to sales. Very good. What is the value? 30,000.
30,000.
Wonderful. Now, After that, on a very same day, so you'll manage the narration, guys, all of you. Okay. On the very same day, the acceptance is happening because the question is silent. So question is silent, we are believing that on the same day acceptance is done. On the date of acceptance, we have to cancel unsecured Mohan and create a secured Mohan. So secured Mohan's name here is bills receivable. So Mohan is currently in debit. To cancel Mohan, I have to put Mohan in credit. So in place of that, new asset, bills receivable account debit. 30,000, 30,000. Now, if you look at this, guys, if you look at this, the Mohan account, guys, here debit and here credit is knocked off, which means Mohan's ledger balance is now 0. Then what happens, guys? On the very same day, the bill is being discounted with the bank. Now, please understand, this is the first transaction. Second transaction is receiving the bill. The third transaction is discounting of the bill. Discounting of the bill is a process where you hand over the bill to the banker and receive the money. Now, please tell me, guys, in the third entry, if I'm handing over the bill to the banker, can I say credit what goes out? I'm giving my asset to the banker. I'm giving my asset to the banker. So here my bills of receivable asset is reducing. So as per your modern approach, bills receivable should be credited with 30,000 rupees. Yes or no? Online people?
Yes, sir.
Instead of that, what are you getting? You're getting bank account debit. You're receiving the money in your bank account. Are you receiving full 30,000? No, you're receiving less than that because the amount what is subtracted is the interest element. So how do we calculate interest? It's a very simple. Banker is going to help you 30,000 rupees at the interest rate of 12% per annum. So if you calculate 30,000 into 12 by 100, that becomes the interest for the entire year. Am I enjoying the amount for the entire year? No. Banker is given this money on 1st of July and is getting the money back on 4th of October. So banker has suffered this money for how many months? 3 months. So I need to proportionately calculate the interest for 3 months. So 3 by 12. So 30,000 into 12 by 100 into 3 by 12. What is the interest amount? 900 rupees. So from 30,000, if 900 is subtracted, what is the balance amount you'll receive? 29,100. Now, as per your accounting rule, we are following double entry system of accounting where the total of debit and the total of credit should match. Here, there is a mismatch of 900 rupees in the debit. What does it call for? Discounting charges. Now, please tell me, my dear friends, this 900 rupees for the seller, isn't it a loss? Isn't it a loss? Loss only, no. Had I waited till the date of maturity, I would have got 30,000 rupees. Since I'm in urgent need of money, I went to the banker and got it discounted. To that extent, to 900 rupees, I'm not going to get the money back. So it is a loss for me. So as per your nominal account, debit all expense and losses. So discounting charges, which is an expense, account debit to bills receivable. Any problem here? So bank account debit, discounting charge account debit to bills receivable. This is a very, very important entry where people make mistake. Offline people, clear with this point? Hello? Online people?
Yes, sir.
Yes, sir.
Very
Yes,
good. Now, guys, see, this sequence is very important. First transaction is happening between what? Seller and the buyer. That is Prakash and Mohan. Prakash recorded it. Second transaction is also happening between Prakash and Mohan, which Prakash recorded. Third transaction of discount is happening between Prakash and banker, which Prakash has recorded. Now, fourth transaction, when the banker is going to Mohan and getting the bill, that is honourment of bill. Now, this is a transaction happening between the banker and Mohan. Will Prakash record that? Will Prakash record it? So can I say for Prakash, we'll stop with these 3 entries? All in people?
Yes,
I'm saying that
sir.
we'll stop with the 3 entries.
Yes,
Do you have
sir.
any problem here? So here they have recorded 2 entries. Why? Because the first entry is there now, guys. Mohan to sales. They have not captured this entry. They have believed that this entry is already passed. Now in this chapter, we're learning the concept of bill of exchange. So from this step onwards, they're doing the entry. But for me, guys, if I don't teach you the first entry, will you not get confused why bills receivable is debited, why unnecessarily Mohan is created? Now, when I did the first entry, you understood that the Mohan account was already opened. To close, we are crediting Mohan. So to understand the second entry, don't you think the first entry is relevant? So that's why I've done the first entry. Now in exam, you might ask the question, sir, do we need to do the first entry or not? It's a choice. Here they have told give the journal entries in the books of Prakash. So if you are feeling confused whether the first entry to be recorded or not recorded, you always record it, nothing wrong. If they tell you, write the entries pertaining to only bills of exchange, then the first entry is not required. But here have they mentioned anything? Nothing. So even if you write the first entry, Mohan to sales, nothing wrong. Am I clear with this point? Online people, hello?
Yes, sir.
Yes.
Yes, sir.
Now guys, we have to record the entries now in books of Mohan. So next, Mohan. Mohan is the buyer of the goods. So for him, it is a purchase transaction or sale transaction? Purchase transaction. So what is the purchase date? 1/7/2021. When a credit purchase is done, when the goods normal credit purchase is done, what is the journal entry?
Purchase account to Prakash.
Purchase account debit to Prakash account. Purchase account debit to Prakash. Online people keep on saying how much? 30,000. 30,000. Okay. Now, on the same day, the acceptance is done. So Prakash is unsecured. To remove him, Prakash is currently in credit. To remove him, I need to put him in debit. So I need to close Prakash account by giving a debit. So Prakash account debit to bills payable. Now, Mohan has to pay to Prakash money. So it is a liability for Mohan because he has to pay the money. Anything that I have to pay in future is liability. To record liability, I have to credit. So two bills payable, 30,000, 30,000. Now, when you record these two transactions, the Prakash account is being closed. It has to get knocked off. So ultimate entry is what? Purchase to bills payable. Instead of purchase to creditor, it is purchase to bill payable. Bill payable also liability. Creditor is also liability. Creditor is unsecured. Bills payable is secure. That is the only difference. Online people, okay or not okay?
Okay, sir.
Yes,
Okay.
sir.
So guys, the first transaction which I recorded is the purchase transaction, which is happening between Prakash and Mohan. So Mohan recorded this. Then Mohan is giving the acceptance or Mohan is issuing the promissory note. So this is also a transaction between Prakash and Mohan, which Mohan is recording. The third transaction, which is discounting of bill, is happening between Prakash and the banker. Will Mohan capture this? Will Mohan capture the discounting entry? No. So what will he do? He will leave the third transaction. Now the fourth transaction happening between whom? Mohan and bank. So Mohan is making the payment. So on the due date, that is 4th of October 2021, we are settling the bill. We are closing the liability. Liability is currently in credit. To close the liability, I need to put in debit. So bills payable account debit 30,000 to bank 30,000. That's all. Very simple. Any big logic? Any big concept or difficulty in remembering this? Online people, hello.
No, sir.
No, sir.
No, sir.
Please finish this. With this, we're done with the second case where the bill is discounted with the banker. Two more cases, we are done with the concept today. For your reference purpose, I've given all the journal entries here. So you can also just refer it. This is for quick revision purpose. I've prepared these notes for all of you, which I'll be giving as a hard copy to all of you. In that, the disorderment part alone is pending, which we'll be doing today. Do you want a break of 5 minutes or can I continue with the question? Break or continue? Continue? Okay. Gunapati was like first break, but the moment I saw like, let's continue, sir. Come on, I'm having that willpower. Yes. Online people, hello. We'll continue or break.
Sir, continue.
Sir.
Okay. Now this brings to the third case, which is when a bill of exchange is endorsed in favor of a creditor. Now, endorsement, what is endorsement? Endorsement is a procedure where the person who's having the bill, that is a seller, he will transfer this bill to some other person to whom he has to make the payment. So let's take one example to analyze this. I'm practically taking one question to explain this. Let's take illustration 4. Dave owes 10,000 to Krishan. On 1st May 2021, he sent a promissory note for the amount payable after 3 months. My question to all of you. Who is the seller? Who is the buyer? Dev owes. Owes means he has to pay. So who will have to pay? Obviously, customer and buyer. So can I say Dev is buyer? And Krishan is the seller. Who is the issuer of promissory note? Who is the drawer or the maker of the promissory note?
They.
Buyer, Dev, because promissory note is prepared by the buyer himself. Okay. What is the credit period? 3 months is credit period. What is the term of the bill? Nothing is mentioned, so after date. So what is my due date? Due date is equal to 1/5/2021 plus 3 month plus 3 grace days. So May it is there. So June, July, August. 1st August plus 3 days is 4th of August 2021 is the maturity date. On 1st June 2021, Krishan means who? Seller. Seller endorses this promissory note in favor of Wahid, to whom he owed the like amount. Krishan is owing some amount to Wahid, it seems. Which means Krishan has to make the same payment to Wahid, same amount of payment to somebody else, who is Wahid here. So here, instead of waiting till the maturity date, going to again Dev, giving the bill, taking the money, and going and giving this money back to Dev in Wahid in future, instead of doing all this khichdi. See guys, if this concept of endorsement is not there, then what will happen? This is Krishan. Okay, Krishan will go to Dev, give the bill, get the money from him. Then this money he has to go and give it to whom? Wahid. So unnecessarily he has to go to two people. So much of complication rotation. Instead of that, whatever the bill is getting at the first that bill directly he will give it to Wahid. So this step and this step will come. Can I say this step is bypassed? Again, one more time. Let's do it. Krishan is getting the bill from a promissory note from Dev. On the due date, Krishan has to go to Dev, give the promissory note and get the money. Then he has to take this money. He has to go to Wahid and give this money. Complication. Now what Krishan is smartly doing is that this promissory note, what he received, this promissory note, what he's received, he is transferring this promissory note to Wahid directly. So this step and this step is happening. Can I say now this step is not required? He doesn't have to go to Dev and collect the money. He doesn't have to take the money and come back. So can I say his burden is reducing? So who will go and collect the money from Dev in future? Wahid will go and get the money from Dev in future because he is the bearer of the instrument. So can I say Krishan is bypassed one step very smartly? He has put the burden of collection of the money on responsibility of Wahid. So the process of transferring the bill of exchange to another party, this process is called as endorsement. Endorsement is basically transferring the check or a bill of exchange or a promissory note to a third party. So here, who becomes the endorser? Endorser. Krishan becomes the endorser. The person who transfers the negotiable instrument, he becomes the endorser. And the person to whose favor the bill is being transferred, that guy becomes the endorsee. Clear, not clear? Online people, hello?
Clear, sir.
Yes, sir.
Yes, sir.
Now in our example, here seller is Krishan. Buyer is Dev. Endorsee is basically Wahid. Now guys, between Krishan and Dev, who is debtor and who is creditor? Krishan is creditor. For Dev, Krishan is creditor. And for Dev, Krishan is creditor. And for Krishan, Dev is debtor. Now, what is the relationship between Krishan and Wahid? Wahid is creditor. For whom? Seller Krishan, which means Krishan would have purchased something from Wahid. That's why we are making payment to Wahid. No? Why are we making payment to Wahid? Why do we have to make payment to Wahid? In past, we have purchased from him, so that we have to pay him. So, which means in that case, Krishan is the buyer and Wahid is the seller. I'm just keeping the terms very simple. You need to understand the relationship of each one with the other one. Now, guys, the first transaction, we are recording the books of Krishan now. We are recording in the books of Krishan. The first transaction is a sale transaction. So we're in the books of Krishan. Please write in the books of Krishan. In the books of Krishan. On the date of sale. When is the sale happening? 1/1/5/2021. What is the sale transaction? Dev account debit, debtor account debit to sales. What is the sale value? 10,000, 10,000. On the same day, promissory note has been executed. So on the date of promissory note, that is on 1/5/21, we have to cancel Dev, and in place of that, I have to prepare bills of exchange. So Dev is currently in debit. To cancel Dev, I have to put him in credit. So to Dev, debit will be bills receivable account debit to Dev, 10,000, 10,000. Guys, go with the flow. The first transaction is happening between Krishan and Dev, which is a credit sale transaction. Therefore, Krishan has recorded it in his books. Second transaction is also happening between Krishan and Dev, where a promissory note is executed. So Krishan is recording it. Now the third transaction is happening between Krishan and Wahid, where the bill is being endorsed. So on the date of endorsement, which is 1/5/2021, from my hand, the bill is going to Wahid. So bills receivable is no more my asset. It is somebody else's asset. So my asset is reducing. To reduce my asset, I have to put it in credit. 2 bills receivable, 10,000 rupees. What will be in debit? Debit the receiver. Why is he receiving the bill? So Wahid account debit. Wahid to me in my books for Krishan, Wahid is creditor. When I'm making the payment to him, my creditor's account is becoming zero. My liability is becoming zero. To make a liability zero, I need to put the creditor in debit. That's why Wahid is in debit. Now clear? Wahid account debit to bills receivable. Now please understand the sequence. Dev account 10,000 debit. Dev account 10,000 credit knocked off, which means Dev's ledger has become now zero. Bills receivable account 10,000 debit. Bills receivable account 10,000 credit becomes. So which means bills receivable account is also zero. You know, no, debit is plus means credit is minus. Both are opposite to each other. So plus 10,000 and minus 10,000 is zero. Now why the account is in debit? Now why the account putting in debit? Account is closed or still open? Closed or open? All in people. Think and answer. Why the put in debit? Account is open or still open or closed?
Closed.
Closed is the right answer because when the goods were purchased for Wahid earlier, the entry would have been purchased to Wahid. So Wahid credit here and Wahid debit here means account is closed. So some people, they look at Wahid, only one account is there. They think that the Wahid account is now only opened. Wahid account is not opened. The account which is already opened because of the earlier credit purchase, that is now being settled and closed. So it is Wahid to bills receivable. Now, do you have any problem on it?
No.
No, sir.
Now, guys, the fourth transaction is happening between Wahid and Dev. Will Krishan capture that in his books of accounts? No. So can I say with these three entries will stop in the books of Krishan? Online people, hello.
Yes, sir.
Yes, sir.
Please finish till this. We'll go to the next journal entry in the books of Dev. In the books of Dev. On the date of purchase, which is 1/5/2021. As the first transaction, can I say this happening between Dev and Krishan? So Dev will record this. So what is the purchase entry? Online people, please respond. Purchase account debit to
Krishan.
10,000, 10,000. On the date of promissory note being executed, that is on 1/5/2021, we need to close Krishan account, and in place of that, you have to put bills payable account. So it will be Krishan account debit to bills payable. What is the value? 10,000, 10,000. So when I did this, guys, at the end of this, Christian account debit and Christian account credit will ensure that the Christian's account is having no balance. It is zero. So second transaction is also happening between Dave and Christian recorded. Third transaction is happening between whom and whom? It is happening between Christian and Wahid. Will Dave record in his books of accounts? No. So
No.
leave it blank. Now next sequence is honourment of bill. On the maturity date, the bill is honored. So Wahid is coming and giving this bill to Dave, and Dave is making the payment. The question very clearly said that on the due date, Dave paid the amount. Dave paid the amount, which means he's honoring the bill. So can I say the fourth transaction Dave needs to capture, because this is a transaction between Dave and Wahid. So what will be the journal entry? So on due date, that is 4 August, no? 4 August 2021, what will be the entry? Dave is the payer of money. So since he's making the payment, it will be to cash. And this cash is paid against bills payable. So it will be bills payable account debit 10,000 to cash 10,000. Now don't write Wahid. Now tell me, if you write Wahid account debit, what are you gaining? Did Dave open Wahid account before? No. So unnecessarily you put Wahid in debit, you're opening the account. So Wahid in debit means what? That balance will have a debit balance. And debit balance will finally go to balance sheet on asset side. So if you debit Wahid, it will become as if we have to receive money from Wahid. But are we supposed to receive money from Wahid? Once the payment is done to Wahid, the account is settled. So please don't put Wahid in debit. We have to put bills payable in debit. We are making the payment no doubt to Wahid, but it is against the liability, which is bills payable. The amount, the liability account that is opened is bills payable account. In my book, in the books of Dave, have we opened the liability account in the name of Wahid? Please tell me. Guys, my question goes to all of you. In the books of Dave, is the liability open in the name of bills payable?
Yes.
Or is the liability open in the name of Wahid? It
Bills
is open in the name of bills payable.
Bills payable.
So liability of bills payable only needs to be closed now. So why will we put debit of Wahid? So we'll put bills payable only debit. So bills payable account debit to cash. Now these are the three entries in books of Dave. Do you have any doubts here? Hello, online people.
No, sir.
No, sir.
Now
No, sir.
we have to do the entry in books of Wahid. In the books of Wahid. Here's the first transaction. Goods has been sold by Christian to Dave. Is it got anything to do with Wahid? So first transaction, Wahid will not record. Second transaction, Wahid will not record. Third transaction is happening between Christian and Wahid. Will Wahid capture this? Yes. So what will be the entry? On date of endorsement, which is 1/5/2021, what will be the entry?
Bills receivable to
Wahid's point of view, bill is receiving it. He is getting the asset. So he has to record the asset. So the asset is form of bills receivable. The name of the asset is bills receivable. So bills receivable account debit 10,000. And who is the giver of the bill?
Prakash.
To Christian. 10,000 rupees. Now Christian crediting means what? Earlier, Wahid would have sold goods to Christian. So entry that time would have passed is Christian account debit to sales he would have recorded. So that Christian is now closed because the bill has been received from him. Bill is as good as payment. Bill is as good as receiving the money. So Christian account is knocked off. So bills receivable 10,000 to Christian 10,000. Any problem? So this entry you don't have to record. This is already recorded by Wahid in the past. It is a continuation that this entry we are recording. Now, the fourth transaction happening between Wahid and Dev. Will Wahid record this? Answer is 100% yes. So what will be the entry? So on the date of maturity, that is 4th of August 2021, Wahid is receiving the money. So cash account debit against the bill of exchange. He has to give that bills receivable to whom? He has to give the bills receivable to, hand over the bill to Dev. So credit what goes out. The bill is going out. And cash is coming in. So cash account debit to bills receivable. Any problem? This is the entry in books of Wahid. Am I going too fast? This is understandable.
Yes, sir.
I am actually going a little bit fast. The reason being, already have done this special class with me in detail. So again, going in a very slow pace doesn't make sense, because in the special class, how many classes did we take to do these 4 cases? These 4 cases, not 6 classes. 8 cases is 6 class. I think 2 to 3 classes we have done only on, I think 2 to 3 classes we have done only on this. 2 classes. Today we're finishing in 1 class. There's so many other extra questions that we have worked out in the class, which I'm not doing it. Only one sample in each and every question. That's why that special class is very, very important. Now, coming back, one last concept is left. 4th case, case 4, bill sent to bank for collection. Before that, let's have a quick glance at this. Sale entry they have not recorded. We recorded a sale entry. So this was the 2nd entry, and this is the 3rd entry in our books of Krishan. They have same 2 entries. Invite same 2 entries. Any problem? Online people, any problem with the 3 concept or 3 cases that we discussed so far?
No, sir.
No, sir.
First case is bill held till date of maturity. Second case is bill discounted with bank. Third case it is bill endorsed to the creditor or a third party. Now the 4th case and the last case that we are discussing is when the bill is sent to the bank for collection. Bill is sent to the bank for collection. Can somebody tell me what is the difference between bill being discounted with bank and bill being sent to the bank for collection? What is the difference? What is the response? What is the difference in responsibility of the banker here?
Instead of you collecting the bank, you're appointing the banker to collect it.
Right. Offline people, bye.
Discounted the bank is they are in urgent need of money and then they are collecting the money from the bank. But bills, like in case in the future we might forget to collect the bill, we will ask the bank to collect the bill. Yes.
Correct. So in case of bill being discounted from the bank, so banker there is acting as a person who is lending us the money. So banker, the role of a banker is that of a lender in case of bill being discounted. Here, when the bill is sent to the bank for collection, here the banker is not our lender. Here banker is our agent who is doing the collection work on behalf of us. Why? Because sometimes it so happens that the person who's supposed to go and produce the bill on the due date, due to any personal reasons or due to heavy load in the business work, he might not be in position to go and present the bill to the buyer. Now, if the seller is not presenting to the buyer the bill on the right time, what will buyer say? You did not present the bill, so I did not make the payment. It's a very easy excuse for the buyer. So seller does not want to give an opportunity to the buyer to default the payment. Therefore, he is appointing the banker as an agent, saying that banker, on the maturity date, I'm very busy with my office work. I'm not waiting like you are. So therefore, go and present this bill to the buyer on the maturity date and get the money for me. So banker will say what? You think I'm your servant to do this service free of cost? Correct? No? Seller will say that, no. You do the service, not free of cost. For that, I'll pay you some charges. Don't do free of cost. So here, when the seller is appointing the banker as an agent to collect the money, for collection purpose, for doing this activity, seller is paying some charges to the banker. I'll be able to follow. So now when banker is getting some service charge, definitely will not say no. So he will go and get this money from the buyer and give this money to whom? Seller. So here the banker is acting like an agent who is going to do the service work. He's going to do a job of a courier boy, going and giving the bill and collecting the money back. Whereas in the bill discounting case, the banker was not an agent. Banker was acting as a lender. He lent the money in the emergency for which we had paid him what? Interest. So there it is interest charges. Here it is service fee. Here we are paying him a service fee. The service what banker is doing for collection, no? For that we are paying him a service fee. So let's take a practical question to understand. A 2-month bill of 60,000 is drawn by B & Co and accepted by C & Co, payable at the Bank of India. So who is the drawer of the bill? B & Co is the drawer. and C&Co is the drawing. Who's the buyer? Who's the seller?
B and Co is the seller. C and Co is the buyer.
Perfect. What is the bill amount? 60,000. What is the credit period? Credit period 2 months. What is the term of the bill? Nothing mentioned. So after date. B and Co gives the bill to their banker for collection. So this is bill sent to the bank for collection. On the due date, the bill is honored. So this is case number 4. Show what entries will be passed in the books of B and Co. We'll do both books. Now, guys, what is the due date? So due date is equal to, or the maturity date is equal to, date of issue plus 2 months plus 3 grace days. What is the date of issue? Not given? Leave it. No problem. So instead of putting the date, in that we'll mention date of issue, date of acceptance, date of sale, date of purchase, like that we'll mention. Now, guys, let's do in the books of both. First, B and Co, seller. In the books of B and Co. In the books of B and Co. So, guys, here there is no information about sales. Directly they're telling that the bill is drawn. Just for a knowledge purpose, I'm doing a sale entry. So, on the date of sale, what would be the entry? This is only for knowledge purpose. Huh? In exam, no need to do. We are selling the goods to whom? C and Co. So, C and Co is my customer, my debtor. So, C and Co account debit to sales. What is the sale value? 60,000. On the date of bill being accepted, we are cancelling the debtor, and in place of that, we are creating a secured debtor. And what is the name of secured debtor? Bills receivable. So, bills receivable account debit to C and Co. How much? 60,000. 60,000. Now, guys, the first transaction, if you come back to this, the first transaction, goods sold, we have recorded. The bill being accepted, recorded. The third transaction is bill sent to bank for collection. So this is happening between B and Co and bank. B and Co and bank. So will B and Co capture this entry? The answer is 100% yes. So on the date of bill sent for collection, date of bill sent for collection, what will be the journal entry? Guys, from my hand, bills receivable is going out. Debit what comes in, credit what goes out. So 2, bills receivable 60,000. Asset is going out. Asset is reducing. To reduce asset, credit. Debit, if you put bank, it will be wrong. Guys, when do we debit bank in the journal, in the entire accounting process? Whenever we receive money from the banker, that is when we debit bank. So if you debit bank here as if the money is come to your bank account already, it will sound like that. But did you get the money in your bank account? No. So you cannot put bank here. So here, instead of that, we create a new account called as bill sent for collection. Bill sent for collection, 60,000 rupees. Now observe this very carefully. Guys, in the previous transaction, C and Co debit, C and Co credit is knocked off. Ledger balance is 0. BR account debit, BR account credit, it is knocked off. So which account is open as of now? Bill sent of collection is open. So if you open ledger for the 60,000 rupees, this ledger will have a debit balance brought down 60,000 rupees, which means this will go and sit in balance sheet on which side? Debit balance goes where in balance sheet? Asset side. So on asset side, bill sent for collection like that, it will be flashing, which means what? This is an intimation that this money we are supposed to collect from the banker in future. Asset means what? Anything that you own as asset. Land, building, plant machinery, you own it. Cash, you own it. So it is asset. Anything that you have to receive from somebody in future is also asset. Bank balance, you have to receive money from the banker. Debtor balance, you have to receive money from debtor. Bill sent for collection, this is the money to be collected from the banker. So these are all the asset. So bill sent for collection, debit means having a debit balance. If you open the ledger, bill sent for collection, if you open the ledger, it will have a balance brought on debit side. All of you know how to prepare ledger? All of you know how to prepare ledger?
Yes,
Yes,
sir.
sir.
Okay. Now, guys. Correct. The bank's name is of no use as of now because if you put here, let's suppose Bank of India. If you put Bank of India debit, it means that you're debiting bank account. So whenever we mention Bank of India or bank, both are same. Why do we just mention bank account? Because we don't know which bank account they opened. So we generally put bank. In real, we'll put Bank of India name. If you're having an account in Axis Bank, you'll mention Axis Bank account. If you have your account in HDFC Bank, you'll mention HDFC Bank account. Here in question, they never tell us which bank account. So we just put bank blindly. You get my point? So if you put here even Bank of India karke name, if you put, it is as if you are recording the amount in the bank account. That will be wrong. Because here we have only sent the bill for collection. Money is not yet come. So we are creating a new intermediary account called as bill sent for collection account. So until I receive this money in the balance sheet, if you see on the asset side, bill sent for collection 60,000 will keep pending here. It will keep flashing your eyes. So this is an indication in the balance sheet on the asset side. This is an indication that this money is basically supposed to be received from the banker, which is being sent as a bill for collection. Am I clear with what I'm saying? Online people, hello.
Yes, sir.
Yes, sir.
Now, guys, come back here. The fourth transaction is happening between agent, that is banker, and the buyer, which is C and Co. Do you think this fourth transaction we will capture B and Co? Do we need to capture the fourth transaction? No. Fourth transaction ke baad, after that, once the money is got by the banker will now give this money to us. We are receiving the money. Now, can I say the fifth transaction is between banker and the seller, that is B and Co? This entry we will capture. So what is the fifth entry? On the date of receipt of money or on date of maturity. On the date of maturity, we are getting the money from the banker. Now bank account will be debited because the banker will put the money in the bank account. And against that, don't you think this asset needs to be closed? Until you get the money, this is asset. Once you've got this money, the asset has to be closed now. So to bill sent for collection. 60,000, 60,000. Any problem? If there is any banking charges, then that entry will come separately. For example, let's suppose there is a banking charge of, let's say, 1,000 rupees. If there is a charge, then what will happen? Banker will not pay you full 60,000. He'll pay you 59,000 only. So service fee account debit 1,000 rupees. 59,000 rupees banker will pay you. In that 1,000 rupees will deduct, and the bill sent for collection is for how much? 60. So 60,000 worth of bill you gave to the banker. In return, how much money you got? Only 59. Why did he deduct 1,000? He deduct 1,000 towards a service fee. So in case service fee is coming, then this will be the entry. Bank account debit, service charges, service fee, bank charges, account debit to bill sent for collection. Now clear? Online people, clear or not clear?
Yes, sir.
Yes, sir.
Only 2 people replied. Others are sleeping. I know.
Yes, sir.
Yes, sir.
See, yes, sir. Say. Everybody saying yes, sir. I'm telling you, you're sleeping. You said yes, sir. Very good.
Yes, sir.
See, yes, sir, again. Now, in whose books you have to record, Mohit? Next. Mohit?
Yes, sir.
किसके बुक्स पे रिकॉर्ड करेगा अभी? In the books of? सो रहा है, मेरे को मालूम है।
नाम भूल गया।
हाँ?
सर नाम भूल गया।
हाँ, बहुत बढ़िया, सोते रहे। Okay, Selena, in whose books we are going to record? Selena. One more person left the meeting. 2 people left the meeting. Who are those 2? Navya and Alvin. Very good. Mokshita, in the books of whom?
C and Co.
Very good. Only Mokshita is listening class. Now, C and Co. The first transaction is happening between B and Co and C and Co. So will C and Co record this? Yes. It will be a purchase transaction. So on the date of purchase, what will be the entry? Purchase account debit to B and Co. What is the value? 60,000. Yeah, everyone confused here. 60 or 10? 60,000. 60,000. Now, Guys, the second transaction is happening between whom? B and Co and C and Co, because there's a promissory note executed. So now B and Co is an unsecured creditor. So I need to close in by putting in debit. So B and Co account debit to bills payable. So on date of promissory note, B and Co account debit to bills payable. 60,000, 60,000. In exam, for God's sake, don't write BP. Don't write 60K. Center will be missed. Marks will be deducted. The third transaction now is happening between whom, guys? It is bank and the seller. Does the buyer need to record this? Not required. Now the fourth transaction happening between agent and the buyer. So on date of maturity, what is happening? Very simple, guys. Bills B and Co account is knocked off. So what is open? BP account is open. BP account is a liability account which is open. Now when the payment is made, I need to close my liability. So it will be bills payable account debit. Liability I need to close to cash or bank. 60,000, 60,000. So after this entry, BP account is also closed now. BP account debit, BP account credit is also closed now. So the final impact is what? Purchase account debit to cash. Now tell me, people, if you have any problem. Online people, hello?
No, sir.
No, sir.
No, sir.
These are the 4 cases that we have discussed. The same 4 cases we'll discuss today evening from the dishonorment point of view. So once we finish off the dishonorment case also, we're done with those 4 cases as well. How do you feel comfortable? Easy? Online people, hello?
Yes, sir.
Easy.
Yes, sir.
Fantastic. So what we'll do is, we'll put an end to the session now. After the session, we have to discuss for 10-15 minutes regarding some topic. So please hold on. I'm just closing this recording video. Online people, please stay back. Don't go anywhere. Right? So yes, people, that's all from my side for today's session. I'll see you all in the evening class today at 5:30 p.m. sharp. Until then, bye-bye. See you. Take care.